What's going on, guys? Welcome to the Hustle or Stay Basic channel, the Invest or Stay Basic segment. As always, I'm your host, KG, and today I'm going to do another different type of video. I know I've been doing a lot of different investing videos of late, but don't worry, I know you guys have a lot of requests on stocks and companies you want me to take a look at, so I have this list here. I will get to it. I'll get back to those next week. Now, moving on to the purpose of this video, the definition of an intelligent investor is that who sells to optimists and buys from pessimists. And there's a lot of optimism in the market today. And as an intelligent investor, there's a lot of concern of, hey, should I be buying at these valuations? How does the economy look for 2021 and beyond? And what should I be doing? And in this video, we're going to go look at Howard Marks' memo on the 2021 economy and beyond, and see what his thoughts are. If this video provided you with any value, like it. I know you guys are already subscribed, but if you're not, subscribe. And so let's get into it. So the very first question is, who the heck is Howard Marks, and why should I even care about what he thinks? And I think that's a fair question if you haven't heard about him, but you should know about him. He's a world-renowned investor. He has over 50 years of investing experience and has a 19% per year return since he's been investing in his funds. He's 74 as of today. He is the co-founder of Oak Tree Capital Management, where he puts out these memos that I'm going to go through. He's worth $2.1 billion as of August 2020, and he also has the admiration of great investors such as Ray Dalio and Warren Buffett. In fact, Warren Buffett has this little quote here: "When I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something, and that goes double for his book." So if Warren Buffett can learn something from Howard Marks, I know we, the retail investors, can learn something as well. He also has 3 books, the most recent one being Mastering the Market Cycle, Getting the Odds on Your Side, which had a lot of positive reviews, especially from Ray Dalio. So he's definitely seen a lot of market cycles and has great experience. So let's see what he thinks about 2021, the economy beyond, and how investors should be positioned today. But before we get into that, he also had something in his memo where he kind of reviews 2020. And I think a lot of you already know this information, but it's good to go back and reflect and be like, wow, 2020 was a crazy year. So let's go over some of these facts. So the first fact he has here is a pretty wild fact because he's comparing it to World War II and a war. And he says, in the U.S., 340,000 people have died from COVID-19, 85% of the number who died in the 4 years of battle during World War II, which is absolutely insane when he compares those two items. You don't think of COVID-19 as impactful as a war, but clearly it is. A couple other interesting things that happened during the scare of March 2020 is unemployment peaked at 6.2 million. In the U.S., which is an absolutely ridiculous number, and it's been kind of around the 695,000 mark for the rest of 2020. He also mentions that the Federal Reserve grew its portfolio by $2.7 trillion by buying bonds on the open market. And what this does is it increases the money supply in the economy because you're pretty much swapping out bonds for cash, giving people cash. So there's $2.7 trillion worth of cash out there for people trying to stimulate the economy. So that was a pretty insanely high number. He also mentions that the U.S. Treasury funded roughly $4 trillion in grants and loans and for small businesses and citizens. And what this does is, again, similar to what the Federal Reserve did, add more money to the supply, try to stimulate the economy, kind of wake it up as it went through that harsh period in March in 2020. And prior to that stimulation, of course, the S&P 500 index, we all remember, dropped 34%, and that stimulation just kind of jolted the markets, jolted the economy back to normal, and we reached previous highs in 5 months on August 18th, 2020. So pretty wild ride 2020 was. He also has this little blurb here to summarize what he thinks 2020 was. He said, "So we had a health emergency, an ailing economy, the most generous capital market of all time, and strong stock and bond markets. I mean, on one hand, we have a pandemic and a recession. On the other hand, we have strong capital and stock markets that can only be explained by the Fed's and U.S. Treasury's aggressive actions. And that's that $6.7 trillion worth of stimulus that I mentioned earlier. Okay, so that summarizes 2020 in a nutshell. So what can we expect from 2021? Let's start with the good stuff. People have money. There's been estimates that roughly $1.8 trillion of extra disposable personal income, and that's due to the very positive wealth effect from last year's multi-trillion-dollar appreciation on stocks, and even more to come on homes in the U.S. economy. And also when you think about U.S. citizens being cooped up at home, all those vacations, all the times they would have spent money at restaurants and stuff like that, they have that money in their pockets. And we're saying there's $1.8 trillion of extra money to go around in 2021. So really good thing in that sense. It's not like people are poor. Now add the second point that he mentions here is the Fed promises to keep interest rate low for years and to continue buying bonds, aka stimulating the economy even more. So we got interest rates really low. People are going to continue spending, continue borrowing at a high rate, and the Fed is going to continue stimulating the economy. It sounds like money plus money equals money, which means we are nowhere near in a recession in 2021 and good times ahead, I guess. Now let's talk about the risky thing about 2021 and beyond. Is the biggest risk of all is a possibility of rising interest rates. I mean, it says here, rates have declined quite steadily for the last 40 years. This has been a huge tailwind for investors. And when you hear tailwind and headwind, tailwind is a good thing. Imagine you're flying a plane and you got tailwinds pushing you forward, whereas headwinds are pushing you backwards. Just wanted to explain that, but it's been a huge tailwind for investors since the declining rate environment lowers the demand on return on assets, making for higher asset prices, which we are seeing today in the stock market with these crazy valuations. So if the interest rates do start to increase, I mean, we could start seeing people move their money from asset classes like equities and stocks into saving accounts or safer asset classes. And I mean, this is risky because when you think about people getting used to low interest rates, they start to leverage themselves, whether they're citizens of the U.S. or actual corporations of the U.S. They start to take on more debt because they're like, hey, interest rates are so low, we can afford this. But there are other risks associated with lowering interest rates. I'll get into that next. But I mean, if they start tweaking that interest rate level to higher to make up for all the spending that they've done and try to kind of slow down the economy, that could be a bad thing. For example, if I took out a mortgage on $1 million house at 1%, which I can afford, I'd be like, this is awesome. As soon as the interest rate goes to 3%, I might be scratching my head. I'm like, how do I afford this? So it is the risky part that he mentions here in his memo. Now, this is the scary part. I mean, this is what comes with having interest rates at a low level for a long period of time. This is a scary line. Let's read it. There is a chance that the macroeconomic stimulus on a scale closer to World War II levels than normal recessions will set off inflationary pressures of kind we have not seen in a generation, with consequences for the value of the dollar and financial stability. Emphasis added, he says. And what Howard Marks is alluding to here is, hey, we've never seen this amount of stimulus injected into the economy and so many people with money and interest rates low for such a long period of time. This could really devalue the U.S. dollar currency and the purchasing power for U.S. citizens and those using U.S. dollar. So that is a very, very scary item. And if you watch my last video that I put up where I said like inflation is coming, I talked a little bit about that. So if you haven't checked that video, please check it out and let me know what you think. So this is how Howard Marks summarizes this whole memo. By the way, it's an 8-page memo. I'll share the link in the description of this video in case you want to read it yourself. And he's basically summarizing his memo in these couple of points. 1, the economic outlook is positive, although Chairman Powell, and he's talking about the Federal Reserve Chairman, J.P. Powell, he's warning that the recovery remains uneven and far from complete. But he also says that he will keep interest rates low for a year. And if he does keep it low for years, inflation is really going to creep up, and it'll really be a test for him to see how he's going to manage inflation while trying to keep the economy stimulated. And that might be the breaking point for the U.S. economy. Next couple points are very specific to the stock market. And he says, temperature in the market is elevated and there's signs of euphoria and risky behavior. I mean, I see this all the time. I mean, you guys already know I'm very risk adverse. So when I'm seeing some of these valuations, I'm getting a little bit scared. But he also mentions that they are justified by today's low rates, but are dependent on continued low rates. His last point, he talks about the U.S. government and says Washington poses a risk because of one party's control and the anti-capitalist policies of its progressive members. And what he's talking about there, or alluding to at least, is the corporate tax hike that they're thinking about from 21% to 28%. That's going to affect U.S. corporations pretty heavily as well. So he's saying, hey, that seems a little bit scary as well. Okay, Howard, you've told us a lot. Now give it to me straight. What does this all mean? And he has this line here. He says, but the inescapable truth of investing remains unchanged. There is no magic answer, no solution other than superior skill that will enable an investor to earn a high return safely and dependable. And that's especially true in today's low return world. So what does that mean? I'm going to share my interpretation of that to you. And I think what he's saying is, hey, it seems like interest rates are going to be low for a bit. U.S. citizens have a lot of money, and these valuations probably have some runway to go even higher for the short term. And with these valuations getting higher, what that means is you should be expecting a low return from these companies 10 years from now or 5 years from now when interest rates are increased. So here are my other thoughts. Thought number one is offense versus defense. If you're an investor, you're either on offense, very aggressive, or on defense, or a mix of both. And everything that we're seeing today is, hey, it could pay to be on offense for the short term, but it's probably better to be on defense for the long term because, hey, we know interest rates are going to increase. We don't know if it's going to happen in 1 year, 2 year, or 3 years from now, but we know they're going to increase, and we know when they increase, valuations are going to drop because they're just going to be safer options for investing or compounding your money. So my thoughts are, if you are a 7 on that 0 to 10 scale, where 10 is super aggressive and 1 is like very defensive, maybe you want to tone it down to a 5 or 4 at this point, because there might be a couple of years of gains that you miss out and you might have some FOMO. But I think when interest rates do increase, you'll be feeling good about that. Second item is invest in your circle of competence. I mean, this doesn't have to do specifically with this video, but I mean, anything I talk about, invest in things you know about. Don't invest in like a oil tanker company that you have no idea how it works. Like, invest in things you know about, things you use. I mean, that will always keep you ahead, give you the edge as a retail investor, and have an ownership mentality. When you're investing in a company, try to learn about the company, know the inside outs about the company, the financials. This will give you the edge as well. So stocks only go up, and it looks like they might be going up for the next couple of years or maybe a year at least. But does that mean you should be investing and buying at high valuations? I mean, that's all based on your time horizon and your appetite for risk. If you found this video helpful and valuable, like the video, subscribe. I really appreciate it. Drop a comment. Let me know if you agree or disagree with Howard Marks, and I'll catch you guys next time for the Investor Stay Basic segment. See ya.